Good morning, ladies and gentlemen. Well, the model score is still in the highest bin, and the dumb model continues to outperform any kind of too much thinking about things. It's going up and continues to go up because the momentum is there. We are not very far away from the median performance during risk on, and it basically just shows you that the odds of a deep drawdown in any kind of risk off is very, very far away. I would have thought it's at least 3 months away, and it is what it is. We will continue to be in risk on for quite some time. What interests me for next week is what the very short end of the curve will do. Last week I told you that basically at this area, 95.45, it was very, very difficult for SOFA Z24 to stay below that level simply because the level is 3 cuts. And we know that the dot plots say 3 cuts, and it's very unlikely that the market will push below 3 cuts any time before it sees the CPI in roughly 10 days' time, 2 weeks. So what's the market going to do? Well, the market is likely to retrace higher over the course of the next few days, and these are the levels that I'm looking at: 95, 72, 73, which are these highs on the weeklies. This is naturally a weekly chart. And then the 0.382 retracement, which comes in at 80. I very much doubt that the market can go through there, because that is actually adding an extra cut to the 3. But markets do that sort of thing. And this area here between 72, 73 and 80 is the area that we will be looking at to short. Next week we have Powell up on the hill, and if he's not bearish, and I don't think he will be, why would he waste an opportunity to be wrong, as it were? Why would he say something very bearish when he has the CPI in a week's time after that? And he also has the FOMC where he has to discuss things with his colleagues. Why preempt that? So the market can take the absence of anything bearish from Powell as a validation that yes, he wants to cut, and let's go for more than 3. Let's get to up here. And I think this is going to be an excellent level to buy put spreads and look for more reversals back down to this 45 area, because I don't think the CPI is going to help enough. If it does, then we know what to do. We buy the belly of the curve, because that's going to go the furthest against it. If we change the time frame to daily, and this is now a daily, you can see how well this 72, 73 area and then finally this 80 area will coincide with the 200-day moving average, which is pointing very much down, and the 50-day moving average, which will turn. So I think this area here is going to be the ideal area to short something. Very, very unlikely that we can go through there before CPI in 2 weeks' time. Let's have a look further out the curve. This is now 2s, and it's trading technically very well, isn't it? It touched the 475 at the same time as SOFA was saying only 3 cuts, and then it's pricing in some more because it just couldn't go any further up. Where is natural resistance, and where do I expect 2s to be when SOFA touches that 72 to 80 area? Well, I expect it to be no lower than 442. To me, this area in 2s is also a great big short, And if we look at fives, that area is 406. Very difficult to believe that the bonds can go further than this without some data that justifies more than three cuts or sooner cuts or whatever. Very, very unlikely that we're going to do that. Basically, all the market has done is retrace 50% of this move and stop there, and now it's going to faff around in this area between 407 and 427. If we look at tens, very much the same kind of thing. Very, very unlikely to go any lower than 407 down to, fill this gap, maybe a 402, 401, and that is about it. I don't think that duration is, long duration is where you want to be. There are still no indications to me that this economy is anywhere near to turning around. And yes, we don't have any issuance next week, but coming up towards the latter part of this month, we do have a lot of issuance, and I expect the market to back up from these levels. 30s, fill this gap maybe down to 422, and that's about it. I really don't see any further than that. And the curve is basically saying the same thing. If we look at 2s, 10s, it just does not want to flatten any more than this 47 area. I still think that the likelihood is that as soon as the Fed starts easing, this curve steepens, a lot. And I am looking, sometime this year for these breaks of this 16 area and for us to come down to here. I really think that with all the issuance, duration issuance there is out there this year and next, whenever the Fed starts easing, this curve is absolutely going to fall apart. The market that is far less impulsive than even the US is, strangely enough, Europe. I think people have come to the conclusion that the negative carry is just too much for the time being, and that the ECB is going to keep on punting these cuts further and further out, and certainly until the Fed decides that it can start cutting. And then probably Europe is going to outperform the US on the downside in rates, upside in prices. But until then, Europe has probably decided that it wants to do nothing because of the huge headwind that is the negative carry. I don't think that the ECB next week is going to say anything different, and therefore this area here around the 470 is just about as far as I can see Schatz go. The bobble, it's even less impulsive, and this kind of area, this 433 to 430 area, I really don't see it much through there. And if we look at the Bund, it keeps on not being able to get through this 251, 52 area. This is my absolute red line in the sand. If you go through there, there's something wrong, something that I don't understand that is going on. Over time, I expect it to come down to these levels again, 232, but really not much further than that. We are in a very tight trading range in Europe, and if we put it onto the OAT, which trades technically very well, 296 to 298 area, it doesn't want to go through it, but it certainly doesn't even want to go much through this 282. We are in this kind of sideways consolidation pattern. I do expect eventually yields to come down, but it's going to take far longer than I thought. And as we can see from the differentials, this is now 5s. It's puzzling to me why Europe is not performing better. But I don't think that we're going to be a million miles away by the end of next week from this 174 area, and I certainly don't think we're going to break these previous lows. I just can't see why we would. I know the arguments about the carry and the issuance, heavy corporate issuance in Europe, but I just find it very, very difficult to believe that we don't think that at some stage these spreads return back towards 200, simply because the American economy is so much stronger than the European economy, and inflation, I think, is going to be higher in the US than it will be in the EU. And therefore, I think the natural tendency for this market, and especially on the very heavy issuance we're going to have from 2 weeks' time onwards, that these spreads should return. So at some stage, if we get a pullback in the bubble and the shats and this market is down here, I think it's definitely a better buy in Europe than it is in the US. But we shall see. I just do not understand why these markets are behaving the way they are. And it's all happening in the short end. So it's all happening in the twos, as you can see, and the fives, which suggests to me the argument is the carry. Tens, much less so, and much more contained. And I think that these levels around 172 are probably going to be a good pickup in bunds against the tens. Well, the DXY has been doing exactly what I thought it would do, and which is not a lot, simply because the differentials really shouldn't move all that much. And on Friday, it finally noticed the differential and it came down. Very difficult to see it coming through 103.50 with any kind of impulsion, and I think that that is going to be your floor for the time being, and I really don't think that we are going to go through this 104.36 area either. So if we look at the euro against the dollar, I think we will test this 108.70, 80 area, but we're not going to go miles above it. I really don't see that. And that gives me, enough confidence to trade the spread against Germany as well, because I just simply can't see that we are in an impulsive period for the dollar. And that is all I've got to say. I think it's very unlikely that we break these lows around the 107.80 area next week, and that will give me confidence. If that does not happen, it'll give me confidence to trade gold. Gold had a very nice move on Friday, and let's have a look at should it continue or not. We've traded this area here around the 2110, 2115 many times, and we tried to break it and we failed. And we know 2140 is the level that I have on the weeklies, which I think is very, very important. And let's see if we can close above it. I would bet not, and I will later show you why. So I do think it goes higher during the course of next week and tests this 2110 area, but I think odds are that it reverses from there, where people get overly long, and it reverses not very far, but something like 2050, 2055. That is the kind of range that I expect for next week, and I'll show you why now. For this to be some kind of a start of a move higher in gold, which some people are proponents of, we have to believe that gold against TIP is going to start going up and making new highs and sustaining new highs. Now, is it possible? Yeah, of course, anything is possible, but I just think it's very unlikely that in a period of high real interest rates, we're going to have gold as a leader. That would mean that people are losing confidence in the financial system or in the reporting of of how TIPS is calculated, i.e., what real inflation is. And I don't see any of that on the horizon. It could be that central banks are just blindly buying it, but I just find it very difficult to believe that in this period where you're getting 2% over sticky inflation of, let's call it 2.5% long term, so you're getting 4.5% nominal, 2% real in tips, you're going to somehow decide that gold is a much, much better buy, and then you've got to take gold 10% higher than it is now. So unless you believe that tips are going to rally massively, which would also mean that basically TLT would rally massively, then I really don't see that gold can be a leader here. This is TLT against gold, and as you can see, it's really done nothing over the course of this year. It's only like a couple of percentage points apart. So I find it very difficult to believe that gold can just go and bust through that 2140 level and keep on going higher by percentage points. I just don't see that we are in that kind of environment where real rates aren't preferable to gold. Now that can change, but there has to be a reason for it. And therefore I believe that all gold did last week is catch up and retrace some of this outperformance that had over it since November, when TLT rallied massively and gold did nothing. So yes, can it go a little bit higher down to here? Absolutely, but that only takes it up into that 2140 kind of area. And unless bonds then start helping, and I don't think they will, and unless real rates are considered rubbish by, for whatever reason, then I really can't see that this market is going to take gold to tip any higher than this kind of level, which only gives you, 1-2% upside in gold, unless tip starts rallying like crazy as well. And I really can't see why that would happen. DBC is still hanging on by its fingernails, which to me continues to be odd because oil is performing much better. However, it's still in this range with 82 at the top. And we do have these constricting weekly Bollinger Bands, so the odds of it going much through 82 are not great. And that tells me that inflation is not going to be a huge problem for the time being. Yes, we are, $5-7 higher we will be in oil on the year. And that to me is going to hold back bonds. It's not going to allow them to go much higher. And then I don't see how gold can really go, spurting $100-200. It can do a couple of percent, but not more than that. So that's my argument. I really don't see that the commodities are a problem at the moment. DBC would be showing some damn signs that it wants to go higher, and it's not. And oil would be much more impulsive than it is. It keeps on basically trading the same range, saying that this kind of area sub 70 is too low, but it's also saying that this area above 80 is too much. So we are where we are. We are stuck in ranges, and that to me is not an argument for gold going hundreds of dollars. It's an argument for it going, saying that 2050 is too low, but probably 2150 is too high. What to say about a market which is basically a one-way street? Not a lot apart from, I guess, don't short it. it's very difficult to believe that we can keep on going up at this rate. But on the other hand, every time it comes down and tests these moving averages, whether it be the red one or the blue one, we just keep on bouncing off it, and really very, very easily. And we keep on going up at the rate of this Bollinger Band, which goes up by 0.25% per day, and we keep on going higher. Now, we do have a lot of warning signs on something like not the weeklies, but the monthlies. The monthlies are basically saying that we are, on drugs. And here is the monthly chart, and we are right on top of the Bollinger Band. At some stage, I do expect it to test these moving average, which will be around the 5,000 area. That's not a very, very big move back, is it? So just below 5,000, I'm convinced we'll see 5,000 again, but that is not a bear market. That is just a market which is going up to sideways, consolidating and going back up. I really, however much I try to get bearish of equities on a valuation basis, until price confirms, I think it's just pointless. You don't want to be buying at ridiculous levels and chasing it, but every dip seems to me to be a very low risk buy. While the SPY is at the top of the monthly Bollinger Bands, the one that isn't is NDX. NDX has got room till 18,800, let's call it, for the monthly Bollingers to catch it. And, when the market is making new all-time highs, apart from monthly Bollingers, that is the only kind of resistance that the charts are going to show. It just tells me that the momentum is so strong that I really would now not want to short it until it's above 18,800. And when we get there, we will, people will start talking about 19,000. And when we get to 19,000, people will start talking about nice round numbers like 20,000. I just don't see any point in shorting it at the moment. We need to get some definition. And even if we get some, if we look at something like the 195-minute charts, there is nothing bearish about here. Yes, it could come back down a couple of hundred points and test this 18,070 level, but that is not anything that is going to change its current definition, which is basically going up at the speed of this blue line. It stops at the upper Bollinger Bands. It goes up slowly, retraces. Absolutely nothing that is showing an excess at the moment. You will agree. You will see a very, very big candle when we are turning, and that candle is probably going to be way through the Bollinger Bands and then a close back below and a very nasty red candle. We're just not getting that at the moment, and it's consolidating, going up, consolidating, going up. It's not the kind of environment you want to short at all. I am still convinced that EEM will trade 42.25. That's 5% away. So we are still in this bullish phase. And if I think EEM is going up, it's unlikely that the US is going to outperform it on the downside hugely. You can see that unless I start thinking that these other markets are turning, and I don't see any evidence for it. I mean, look at the Nikkei. I mean, it's just a beautiful bear flag and bull flag, and off it goes. Are we hugely overbought? Yes, we are, but we need to see some definition, some candle which rejects some kind of a level. So why sell it? I really don't see any point at the moment. Even the one that I'm least bullish on now, and that is Europe is not really showing any signs. I expect Europe to consolidate around these levels, but it's not. It's, you know, it's still going higher. It's not showing any signs that it want to reverse, and any reversal to me would only be to around 4700, which is, I don't know, 3-4%. Uh, yeah, which should give you at least 2 or 3% in the SPX, which would be what, 150 points, and those are the levels that I showed you. But that is all normal trading, as opposed to a change in trend, and therefore dips are still buys. I still don't see that that is, you know, going to change, and therefore I much prefer to wait to see a tradable candle than to blindly short it or buy put spreads, because I think at the moment that is just pointless. I just think that the volatility market is going to show us also when the SPX or the QQQs or the stock markets in general are overbought at unsustainable levels, and they're just not doing that at the moment. This ratio has to be much higher than it is to provide us with any kind of idea that even though we might go up, we will come back. At the moment, it's just not doing that. It's very neutral, which says that this trend is likely to continue slowly, you know, with days that are going to be down 1.5-2%, and then we continue. To me, this is the kind of environment which is exactly the same as what the Risdal is saying. You buy the dip, and until you get a really nasty day candle, a reversal after a big blow off top, that is when you can start thinking about shorting it. Otherwise, it's really not that kind of environment. If you look at the VIX, that has to spike lower and then return. This kind of pattern to me just says that slowly the VIX is just going to get compressed towards 12. And that is not an environment which says that we are anywhere near an imminent, violent return to the mean in the stock market. It's just not. I don't see anything much to do next week apart from wait for SOFA to get to levels that are tradable and then trade them. I showed you earlier what I think those levels will be, and that is all I'm really looking for. I think gold is going to be interesting insofar as I am long and I want to sell it around that 2140 level. Anywhere between 2110 and 2140. I think with the momentum it built, it can probably get to 2140, but I'll get out of half at 2110, the other half at 2140, and I'll have, you know, sort of a stop at break even. That is all I can see at the moment. I really don't think that bonds can rally very much. The levels that I showed you are going to be very good shorting levels for the bonds, because I think at some stage the yield curve will go positive, but it'll go positive when the Fed starts cutting, and that is a long time from now, and I really can't see the long duration bonds doing anything at all until then. Okay, thank you very much indeed, and tweet you tomorrow.